3, we begin with the business cycle, the boom part of the business cycle. So, business cycle begins exactly one way: credit expansion.
Sorry, Professor.
Yeah?
Didn't we stop last time on business cycle theories?
Yeah, I'll leave that for probably somewhere around the end. I still have real good stuff to cover, so even if we skip the schools, it's not that much of a disaster. I'll try at a later time. So credit expansion, which economically is equivalent to inflation. All right. Here's the first key. The first key is that the initial effect of credit expansion are identical to lower preferences. So, when you expand credit, supply of credit increases, and supply of credit increases is the same as if the supply of savings increased. So, in other words, entrepreneurs seeing more credit on the market are fooled that savings increased. So, this is the same as lower time preference. So, what are the effects? Number one is, well, let me try to do it here with the black one. Number one here is increases consumption. This is a straightforward result which we covered during effects of inflation. Credit expansion is the same as inflation, and one of the fundamental effects is rising consumption. Number two is it lowers artificially interest rates. In other words, if you want to increase the supply of credit, the only way to increase the supply of credit is to lower artificially its price. So the price of credit is interest rates, it lowers interest rates. Another effect which is always present is the value of capital goods. Capital goods value increases. So, the value of capital goods increases. So, real estate prices go up, stock market goes up, other valuable capital goods, machines, equipment, trucks, etc., their value goes up. Another one is a straightforward result from inflation: illusion of increased profitability. Again, this is something that we covered in the effects of inflation. Overall rising prices, including consumer prices, provide an illusion to increased profitability to businessmen. The next one is also straightforward. Anytime you have increased credit and lower time preferences and also lower interest rates, it widens and lengthens production structure. Or what I should probably say better, it initiates the process of widening and lengthening of the production structure. So businessmen start to build out longer processes, they start to invest more of the same stuff. So I have like 5 taxes, now I'm going to invest and get 2 more taxes, whatever that means. Taxi is a cab, right? Not as taxation. Alright, so, and of course EF shifts resources shift from low order capital goods, which we called consumer goods, into high order capital goods. So, entrepreneurs begin to invest heavily in higher order capital goods They don't produce as many toothpastes or whatever the consumer goods might be. Alright, so now what you gotta understand is that there is nothing, absolutely nothing new. All I did was basically review familiar stuff. It happens anyway. Well, at least reviewed familiar stuff from inflation, because in inflation you have illusion, okay? So, what's next? Next, number 2 is one of the explanations of one of the problems, mass entrepreneurial errors. So, suddenly entrepreneurs commit a whole bunch of errors. Number 1, I'm all doing repeating, is illusion of increased profitability. So the first thing is that entrepreneurs see increased profitability, and they are, actually it's just an accounting illusion. Number 2, which is very interesting, it's easy to observe even today in Bulgaria, is a massive wave of optimism. There was such a case right before the Asian crisis in 95, 96, in early 97. You probably have heard the expression Asian tigers. They were supposed to overtake the world. Before that, Japan in the 80s was undergoing a phenomenal boom. There was a wave of optimism. There was illusion of profits. American businessmen began to fear that the Japanese are so damn good that they're going to overtake the American and the world economy. That their business models were much better than everything else. Well, that was an example of optimism. Of course, we had the same thing with our Bulgarians' entry in European Union. We entered in 2007, January 1st. But in 2005 and 2006, we had this massive credit expansion undergoing due to an influx of foreign capital. So foreigners bring in foreign currency. It enters our currency reserves. Our central bank expands on top of these reserves. And then commercial banks expand on top of these. So we had a massive credit expansion, and suddenly we're the Eastern European economic tiger. Well, we probably are not, but at least we created for a couple of years a wave of optimism, and people believe that we're actually finally undergoing, we're finally becoming a real European country. Well, the better explanation is just the credit expansion fooling people that we're making actual progress when in reality we're making little progress. Alright, the other one, again, it is part of number 2, is a sense of prosperity. Well, here's the deal. Money supply grows, part with credit, at 30%. And prices, let's say 2-3 years ago, were growing at 10-15%. If prices grow at 15% and money supply, including credit, grows at 30%, apparently we are kind of like getting richer by 15% a year. Well, this is part of the illusion of prosperity and part of the optimism. But money supply grows faster than prices, and everyone feels richer. Of course, when people actually try to spend the money, prices rise faster than the money supply. So, essentially, first phase of inflation, this is now we're tying back to money supply. First phase of inflation, where money supply rises faster than prices, always creates a sense of prosperity. Well, that's another effect. And finally, well, one more process of maladjustment. So what is is a maladjustment in an economy? A maladjustment essentially is making the wrong investment. Making investment decisions which are poor. We call these investments, we call them malinvestment. So the process of maladjustment is a distortion of the overall macroeconomy because entrepreneurs begin to invest too heavily in some sectors, like today in Bulgaria real estate, or like in 2002, 3, 4, and 5 in the United States in real estate, and at the same time they underinvest in other sectors. In the US this might be, let's say, mining, agriculture, energy, crude oil, natural gas, and all of those things. So the maladjustment process essentially means that some sectors are growing unjustifiably fast and other sectors aren't growing enough to keep up with the economy. Crude oil. US has not been exploring, searching and finding sufficient crude oil in order to satisfy its own market. So the result is crude oil prices keep rising and rising and rising. Also because of oil scarcity as well as dollar devaluation or simple straightforward price inflation. Alright, let's see what else we have. We also have intertemporal Remember when we were talking about capital and structure, intertemporal coordination? Well, now you get what's called intertemporal discoordination. So, intertemporal coordination occurred because the interest rate was performing this function of balancing present and future goods. Now, because of credit expansion, interest rates are distorted, artificially lower, and now the interest rate does not perform well its function of intertemporal coordination. The result is called discoordination. Alright, is that fairly clear? Alright, so these two, now let me see how I go about it. Now I go about it the heart of the issue, and the heart of the issue is why, once the boom begins, it must necessarily end. In other words, when the boom initiates, it must at some point reverse. The reversal of the boom we call a bust. But the question is why there must be a bust. And this is probably the hardest to understand because there is still that general belief that once a boom is initiated, as long as the government intervenes sufficiently hard, they can always maintain the boom forever. Well, it is impossible, but the key is to understand why. So all I will go through probably the rest of the day is the 6 fundamental causes for boom reversal. So we go to boom reversal. And this is essentially the topic of today's lecture, why the boom must end. First is fairly straightforward. Factor prices, so prices of factors increase. So, which were the factors? Labor, capital, workers, wages, rent, all of these prices increase. So this is what happens, and now we gotta do is reasons. So there's got to be a reason. So we got to understand when something happens, first of all, why it happens, which are the reasons, and then what are the consequences or the implication. So why prices of factors must necessarily rise?
Inflation.
Yeah, inflation, but it's a little more than just inflation. Yes, inflation, everything's got to rise, but factor prices might actually rise a little faster than that.
Maybe entrepreneurs overinvest so the demand increases, and as a result it's necessary to increase the price to fit it to the activity.
So here is the deal. Entrepreneurs invest or increase their investing in high order capital goods. So you have a massive wave of investing in high order capital goods, but here is the deal. No resources were released from low order capital goods. You understand now, all I'm going to be doing most of the day is argue why things happen, and the argument is always the same. The argument is there was no savings. Savings did not increase. That's why this whole picture occurs. So, high order capital goods investments rise, but at the same time, no resources were released. In other words, economic growth worked because when you try to shift to high order capital goods investments, in other words, when you try to invest in capital goods, you were actually releasing resources from low order capital goods because consumers consume less and the profitability of low order goods fell, so resources were released. Because resources were not released, this is the cause. Okay, and of course you have reason number 2, which is increased monetary demand. In general, demand for factors goes up simply because there is credit expansion. So essentially your argument is, essentially the same. But that's part of the reason. It wouldn't work unless there was, no resources released. That's the key. Alright? So, this is reason 1. Reason 2, let's see consequences. So, all I said so far was the following. Prices of factors rise because of this and this. And the answer is, so what? So what? Again, project costs rise. So, for example, you're now having what's called a oil boom. Crude oil prices are rising. Businesses, meaning oil companies international, as well as national oil companies, are trying to hire oil men. That's how they're called, oil engineers, technically called petroleum engineers. You guys should not be studying economics and finance, you should be studying petroleum engineering. These guys, petroleum engineers, now, because of this massive demand, are commanding higher salaries. Their wages and salaries doubled in 3-4 years. Within the next 3 or 4 years, you're going to be expecting that they will be making twice more than they make now. Back in the old days, like 10 years ago, petroleum engineers would make 1/2 or 1/3 of, let's say, a finance professional or a banker. But now, these guys are making actually more. And they have higher and better prospects. Well, now, back in the old days, you were a petroleum engineer making $50,000 or $70,000. Now, 150 is not enough. You graduate, you can start with $200,000. It certainly raises the costs of all sorts of investment projects. This is something absurd which I heard. It's actually perfectly explainable by what's going on with the business cycle today. We have quite a few people in our banking financial system leaving the banks and moving into construction and doing inside construction work, walls and all this kind of stuff. And they were making more, pretty much twice more than as bank employees. Why? Phenomenal construction boom, phenomenal shortage. Of course, there is no shortage of construction workers. You just pay them high enough and most bankers will become, construction workers. They just offer to a banker twice the money, for something else. He's going to leave banking and go wherever the money is, all right? So, project costs rise dramatically. If project costs rise dramatically, then profitability falls and could possibly turn negative. Falls and turns negative. Or it may turn out into losses. So, let me try to summarize again for you. Because the price of workers, employees, other costs, everything that is related to factors of production rises, project costs increase, they lower dramatically productivity, and they possibly turn many apparently profitable projects into losses. So, because there were no savings, profitability of high order capital goods turns out to be negative, all right? So, that's number one. So, this is one reason. So, prices of consumer goods, why would prices of consumer goods rise? Why? What's the reason?
Because the prices of factors rise. It's a direct consequence. The more money you need to invest, the more you need to charge consumers.
Okay, wait a minute. We're talking now, when we're talking about investing, we're talking about capital goods. Now we're talking about consumer goods like toothpastes, movies.
Probably because of the shortage.
Huh?
Probably because of the shortage of consumer.
Why would there be shortage?
Because everybody uses capital.
Oh, okay, because there was a shift into capital goods. In other words, because the shift from low order to capital order goods means that less consumer goods will be produced, while did demand go down or not? No, it did not go down simply because consumers did not change its preferences. That's the bonus point, right? So, reason number one was demand unchanged. In the sense of time preferences did not change. But I am making now a stronger statement. Consumer demand actually rises. Why would actually consumer demand rise?
Would you explain the difference between demand and
Consumption increases.
Oh, demand, I'm talking, okay, why, what's the difference between demand and consumer? No difference. Number two, P's. So number two here, I'm talking entirely about consumer goods. So this is, again, consumer demand. So consumer demand was unchanged. Reason, time preferences did not change. This was the assumption. If time preferences changed, remember, we're in the world of growth, not business cycles. So, but why would consumer demand actually rise?
Because there is a shortage of products.
No, wait a minute. There is a shortage of products simply means that supply did not increase as much or supply shrank. You cannot mix up demand and supply.
Cost from production of high level. Cost by production of high level.
Wait a minute. I'm talking demand. Don't try to provide any supply arguments. I'm asking demand.
With the credit expansion, people get the feeling they have more money, so they start spending.
Oh, yeah, people feel richer. This is the wave of optimism. People get more money. But there is another, this is good argument, but there's a little better argument. Let me try. Prices of factors rise. These include wages. So suddenly workers get more money. You're a construction worker, you're making 400 lev a month. Now you're making 1,000 lev a month. Bankers were making like, I don't know, mid-tier banker was making like 1,000 to 2,000. Now they're making like 5,000 or 6,000. So, because factors, again, factor might be a landlord getting twice the rent. If rent prices went up, landlord gets twice the rent. Well, he's got more money, so he feels richer, he will spend a little bit more of it, okay? So because factors got more income, remember, these will be referring to income. Because income's increased, rising income will drive demand higher. That's it. Let's see what else we have. Now, reason number 3 is the supply argument. Temporary slowdown of supply. Now, I didn't say that your argument about supply was incorrect. I never said that. I'm trying to say what the demand argument is. Again, we're talking about price here. If we're talking about price, we will have to boil down to either demand or supply or possibly both. So I provided 2 demand arguments, but the supply argument is correct. Temporary slowdown of supply of consumer goods as entrepreneurs find that real estate is more profitable than, for example, making toothpaste. Okay? So that's reason number 3. So now we gotta get to some consequences. So, what are the consequences? And here's one key. Consumer prices rise, and here's the key, faster than factor prices. This is a little tricky. So, if incomes begin to rise substantially, let's say everybody's making 10-15% growth in their salary, landlords take 10 or 15% higher rents, eventually what will happen is, as they get to spend the money, consumer prices will begin to rise even faster than their income. Now in Bulgaria in 2007, late 2007 and early 2008, we are in this stage where incomes grow nominally, but prices rise even faster. This is kind of like entering stage 2 of inflation, where prices rise faster than incomes, and incomes can't keep up with prices. Again, the reason is that there is a temporary slowdown of supply. Again, we're on the topic of consumer goods. Alright? Is that fairly clear? Does that make sense? Let's see what else I have. Well, consequence. Real worker income falls. So, wages of workers fall. in the previous lecture on growth? Yeah, we called them the real wages, but it had a name, an effect. What kind of effect was that back then? The Ricardo effect. Remember the Ricardo effect? Ricardo effect was wages, real wages rose because consumer prices fell, right? Because demand fell. Now consumer prices actually rise and real wages actually fall. So this is the inverse or the exact opposite of the Ricardo effect. So the difference between, one of the fundamental differences between growth and business cycles is that in the growth you get a good positive Ricardo effect. In the business cycle, the Ricardo effect wears off once consumer prices rise, and suddenly, this is kind of like, that's how it's understood as, workers begin to feel impoverished. They're making more money, but they can't keep up with prices. The term which is used, now you will see it practically everywhere in US media and begins to show up in Bulgarian media, is called squeezed. The consumer is being squeezed by higher consumer prices. So his income doesn't go as much, meaning his real income, the purchasing power, fell. So, worker impoverishment. Alright, so what's this consumer prices rising have to do with the reversal of the boom? What does it have to do with the reversal of the boom? Remember, all we're saying now is that the boom must reverse. Why is this arguing for a reversal? Why the boom must reverse? What is the argument here? Come on guys, opinions. Well, of course, one is correct. Bonuses.
Because hyperinflation?
No, hyperinflation is not the argument. Anybody?
Because consumption.
Oh, okay, let's try this guy.
So all the consequences are...
Consequence.
Yeah. They're showing us that profitability and the wages are like going down in the end. So, which means that savings are going down also.
Well, we're looking a little more straightforward. Let's give it a chance.
I think companies are still producing some goods and just people are not able to buy them. So firstly, people are not able to buy goods.
Well, what kind of goods? What kind of goods? Consumer goods or capital goods? Okay, well, consumer good prices are rising because demand is rising.
Yes, but companies have lots of consumer goods that are still on board, and because people don't have money to buy.
Look, demand is rising for consumer goods and supply is falling. It can't be what you're saying. It's got to be something else.
Maybe like another name for the past is a slowdown. What we see on this phase is the slowdown of supply for consumer goods, and also as a recession we can see there's a decrease in the relative real wages of workers. So the situation implies that people are getting, like, so to say, poorer as they feel it.
Yeah. Well, guys, you're trying to give me 3 or 4 step argument when I'm looking basically a 1-step argument, 1 or 2-step argument is simple. Prices of consumer goods are rising and therefore profitability of consumer goods increases. Simple as that. In other words, remember what happened? During the boom, the initial boom raised the profitability of high-order capital goods relative to consumer goods. Now this effect will reverse by raising consumer prices and raising profitability of low-order capital goods. So the idea is the following: if these are consumer goods and these are these are capital goods and these are consumer goods, in the early stage, capital prices rise, they are more profitable, people shift investing there, and then as consumer prices increase, their profitability increases, they will reverse to invest back in restaurants and toothpaste and whatever consumers consume. So the answer is it will restore lost profitability in consumer goods. Remember, the initial stimulus of the boom was shifting to high order goods because they were more profitable, and the relative profitability of consumer goods went down. Well, now this restores the relative profitability. So you're an entrepreneur saying, well, why should I be investing in whatever? I'd rather stick to toothpaste or whatever people regularly consume on a daily basis, like wheat, rice, shortages of rice. Well, when do you think shortages of rice are coming in the US and worldwide? Well, the answer is an overall bust. The economy switching into a global economy switching into a bust mode. So wheat, shortages of wheat, shortages of a whole bunch of agricultural products. Now you have occasional shortages of gasoline in the United States. You go to the gas station, it says out of gas. These are rare reports, and they're not reported on TV, so that there is no consumer panic, and we'll call it a run on gas stations, right? Where everybody decides to top off their tank. Then, you know what's happening, right? Everybody's car is full and gas stations are empty. And then you got a real panic, all right? I don't want to get into that. So, this is part 2. Is it that clear now? Now, 3. Let me see 3. Actually, it's I partially covered it. Consumer good profitability. Rises. So you got an increase in consumer good profitability. Reason: consumer prices rise faster than, so consumer prices are called revenue. And here we have costs. Costs we call factor prices. So, consumer prices we call revenues. Revenues. And factor prices we call costs. So, profitability of consumer goods increases. And let's see. And therefore, as a consequence, we have a shift to lower order, we just call them consumer goods. So the idea was, well, they will run to build real estate. Now they say, well, real estate is not as profitable. Now it's profitable to grow wheat and to grow rice. Okay? All right, so 4 is the Ricardo effect. Again, the argument is identical to the above, as above. Consumer prices rise faster than wages, and therefore real worker wages fall. This is the same argument. So, what is the consequence? Well, the consequence must be the opposite or the inverse of what we've discussed on economic growth. So number one, real wages fall, wages go down, and let's see what else we have. Cheaper labor substitutes for expensive capital. Remember, as the boom went on and on and on, capital prices went up. Real estate now is very expensive. Try to rent some sort of real estate for business purposes. You want to be a lawyer or a dentist or whatnot. Rental prices went up 2 or 3 times if you want to rent an office for a dentist. So suddenly it turns out that capital, whatever the capital is, renting an office for an attorney or for a dentist is much more expensive, and at the same time labor has become a lot cheaper. So now it is easier, or well, more profitable to substitute, to use labor to substitute for capital. Remember, widening and lengthening initially that we had involved the other way around. Use more capital to substitute for the labor. Well, now the Ricardo effect works in the opposite. In other words, the Ricardo effect, which is now a negative Ricardo effect, reverses the initial boom. So whatever started in the boom, as consumer prices rose, it is now no longer worth doing it. Now it is worth doing the opposite. In other words, doing what was the opposite during the boom. Alright, so this is for number 5. Let me see, 5. I can get 5 here. Interest rates rise. Remember, during the early stages of a boom, the credit expansion lowered interest rates artificially below their free market clearing interest rate. Now interest rates must reverse, meaning must come back. So why would they come back? Why would they rise? Arguments.
Because the prices of capital goods go down. Prices of capital goods go down, and the value of capital.
Okay, well, prices of capital goods, okay, hold on, falls as a result of higher interest rates. In other words, lower interest rates drive prices of capital goods up. Now, higher interest rates will push down, but the interest rates don't rise as a result of capital goods. They cause. You understand the difference? Which causes which one? All right, well, let's try a couple of reasons here. The first one is, first of all, let's remember which were some of the components of the interest rates. What were the components of interest rates? Let's try to just enumerate them as we did them a couple of weeks ago on interest in capital.
Inflation, interest rate, and pure interest rate.
Okay, so you had an inflation component, and then you had a pure interest rate.
And risk.
And risk. Alright, so what can we say about the inflation component? It must rise simply because consumer prices are rising. So, once the consumer price effect kicks in, it must be the case that the inflation component rises. So, reason 1, inflation component increases. That's fairly straightforward. Just because inflation went up. People begin now to expect inflation. What about the risk component?
also should increase probably.
Yes, certainly. Risk component increases because suddenly people begin to realize that maybe real estate, construction of real estate is not as profitable as they thought. In other words, as the boom keeps going and going and going, over time, especially when some of these effects kick in, like higher income, higher costs, also higher consumer prices, people get to realize that many of these investment projects will not be as profitable. Here it is, lowering profitability, and many will actually turn losses. So suddenly, the risk component of interest rates must also rise as uncertainty increases in the economy. How about the pure? How about the pure? Well, let me try to argue that, pure. Let me try to argue that the pure interest rates also increase. Here's the deal. As the boom goes on and on and on, you need increasingly more capital and increasingly more credit expansion to feed the boom. Well, once the credit expansion stops, or let's just call it decelerates, all entrepreneurs that begin their investments, like building a 10-floor hotel, or like we building another building here, will have to finish no matter what. You cannot build a hotel to the 7th floor and abandon it. The smart, the sound business decision is to finish it off, get it operational, and you may still suffer some losses, but the losses will be certainly less than to abandon a couple of million, which you used up to the 7th floor, and they get pure zero. In other words, many entrepreneurs will viciously fight for the reduced savings. So here's number one. Demand for credit rises, or actually desperation to get the credit rises. But here's another completely different argument. Remember, credit expansion increased consumption, and credit expansion lowered savings. So the second completely different argument is that savings go down as the boom continues. So lower savings also imply lower supply of credit. So lower supply of credit certainly will mean that the pure interest rate must rise, or must eventually rise. Alright? So even if demand for credit did not change, supply went down simply because people are saving less. Now remember, there's another effect going on. The mere fact that consumer prices are rising, and rising faster than incomes, means now that consumption actually eats a larger and larger proportion of incomes. If you were saving 20%, now with rapidly rising consumer prices, you will be forced to save 10% or to save 5%. So rising consumer prices, also what we call squeezing the consumer, will lower savings, which is yet another reason for rising interest rates. Again, eventually. Now, what you got to understand is that you have the force of rising interest rates, but you also have commercial banks throwing larger and larger massive amounts of credit on the market. So what might happen is they throw in, let's say, 2 billion of credit for our Bulgarian economy. Now you get the reversal process kicking in. Then they throw in 4 billion to offset the reversal factors. Now the reversal processes start working harder. Well, banks throw in 8 million on the market. Alright? And if billion is not enough, then they throw in 16. All right? Well, now I just gave you an example of 100% credit expansion. In Bulgaria, the actual number has been between 45 and 60%. So each year they offer on the market 60% more credit than the previous year, just to forestall the bust effects. Of course, as the boom goes on, second, third, fourth, fifth, seventh year, the cumulative effects that are building up from 1 through 6 begin to take over and eventually overwhelm the banks. All right? So, the only plausible way for the banks to keep overwhelming the reversals is hyperinflation. So, in other words, as banks expand more and more and more, the reversal effects accumulate, become stronger and stronger, and if banks will not allow the bust to kick in, they must necessarily swing in hyperinflation. Now, let's see number 6. Number 6, I'm trying to see where. Okay, I'll draw the line. It is fairly short and fairly straightforward. Number 6. Losses in capital goods. This is kind of like the last nail in the coffin of the boom. So, the boom sooner or later ends, or it must end, because sooner or later capital goods, kind of like real estate, sooner or later becomes unprofitable and turns for entrepreneurs losses. Why would that be? Well, let's try. Well, this one is a little tricky. It is the combined effect of 1 through 5. So, you combine rising prices of factors in combination of rising prices of consumer goods. These two simply represent inflation, right? But rising prices of factors, rising prices of consumer goods, rising consumer good profitability, of course, with a combination of Ricardo effect, and here is the most important of them all, rising interest rates forces losses on capital goods. Why? Because rising interest rates necessarily mean that capital goods prices like stocks and like bonds and like real estate must fall. So, as costs are rising because of rising factors, at the same time, real estate prices or revenues are falling. So, real estate turns out to be a losing investment. In other words, losses in capital goods. So this works like, let's say on, Sunny Beach or whatever in Bulgaria, costs for building them were rising and rising, prices were rising faster. But about a year ago, prices did not continue to rise. Prices fall by 20%, but costs for construction keep rising. And then this year what happens? Costs for construction go up by 20-30%, and prices fell another 20%, and suddenly costs turn out to be higher than revenue. In other words, the cost of constructing the house or the hotel is eventually higher than the sales price. So entrepreneurs turn losses in capital goods. This applies for all capital goods, and the key is rising interest rates, which drives lower the capital goods and the price of capital goods, and therefore drives lower their profitability, meaning turning into losses. So, is it so far clear, guys? Can I take a big breath? How much time we got? 3 minutes, right? Alright, let's see. I am actually 3 minutes early for today because that was exactly the game plan. Let's review what happened. Was what happened was fairly straightforward. In each of these cases, because there was no savings, these effects kicked in. Because there was no savings, these effects kicked in. Remember, if there was savings, there would not have been an inflationary component because consumers would have consumed less and there would not have been inflation. If there has been savings, risk component wouldn't rise because there will be plenty of capital to feed and to feed profitability. And if there was savings, you would not have pure interest rates rising because there will be sufficient savings coming on the market to keep the interest rate lower. So in each of these cases, the savings, meaning the lack of savings, eventually caused and explained each of these effects, and the result of each was the reversal. So the most important lesson that you will learn today, and hopefully, at least in this macroeconomics course, is that booms can never ever last forever, that booms are doomed to end with a bust, and the harder the government tries to forestall the bust and extend the boom, the only thing that they will do is only accumulate more malinvestments and malstructure even more the economy, so that the longer the boom lasts and the more they try to prolong it, only the worse will eventually the bust be. So next time I will be discussing the crisis and the bust and a few other things to finish off the business cycle story. Is this good enough for today? All right. Diversifying and enhancing the return